I think it's kind of fascinating. So what does this mean for founders? I think this gets back to like the IPO dream I wouldn't build towards it these days because it seems like a really not good path.
Right.
Like it seems the
tough path.
Well, and potentially not worth it. Like you might get down that road thinking you want to do the IPO and ring the bell, right? Whereas you might be able to go to private equity, retain a similar amount of control.
Start it up. Let's get it rolling. Big ideas, money folding, hustle smart, dream so wild. Turn that grind into a joyride.
I thought this was kind of interesting. I saw a pattern in the news that I thought might be relevant. Basically, what's happening is nobody's IPOing anymore.
Yeah.
And I thought this was kind of weird. And I wanted to dig into this subject because I think for a lot of founders, there's like a couple of dreams when you start a business. The dream is either, okay, I'm going to create an empire worth $1 gazillion and I'll be rich and famous on my yacht.
Right. So no exit, just kind of keep going.
Just roll it. Yeah. There's a second case where you build something, I don't want to say with the intention to sell, but at least to annoy competitors that are bigger, maybe in a more established market, hoping that they acquire you.
So like a revenge business?
I know you love revenge, but this is more like...
I don't love revenge. But I do find that very interesting when
a common theme among many entrepreneurs, I remember talking to Sam Parr about this, and he gets all fucking fired up about it, is he's always like, oh man, somebody said this to me. And I was like, oh, I'll show them. And years later I sold and I'm like, yeah. And then I look back on the experience and it was actually a very nice email. They were like, hey, good luck. I wish you all the best. Yeah. But at the time I was just filled with such murderous rage that I saw it as, something really threatening. And it motivated me for like a decade. And I'm like, oh, that's ridiculous, but I know exactly what you're saying.
So this is a silly story, but where my cottage is on Lake Ontario.
Yeah.
And there's a park and there's a chip truck there. And the road is called Highway 33. So the chip truck is called Fryway 33. Okay. And I found out that apparently the employees there got pissed off with the owner. And so they went one park up the lake and opened up another chip truck in revenge.
You gotta have that non-compete clause. So you want to work at this chip truck? 5-year non-compete to making your own chip truck, pal. Anyway, that's funny. Actually, in downtown, this is going back to our towny roots in Kingston. There's two Bubba's Poutine. If anybody at Queens knows this, downtown Kingston, there's two Bubba's Poutine.
Yeah.
There's the original Bubba's and Bubba's Poutine. Yeah. The same logo. It looks identical. I cannot believe they must have sued each other a million times. Yeah. But like same logo, basically. Yeah. One just says the original. And it's like two brothers that fought, or like a dad and a son.
Yeah.
And they just, revenge, man. One got pissed off the other.
I can't believe that the post-bar food situation.
Oh, he's getting a phone call. Put it live. I want to hear it.
I put my phone in do not disturb.
No, must have been
important. Still went through.
Cool.
That's weird.
Who was it?
Dad. Chris.
Dad, we're filming right now.
Chris, the solution is in the comp plan.
Yeah. I gotta say, I love that episode. Okay. Sorry, you were gonna say something before Dad called you.
Yeah.
Do you remember? Or is it gone?
No, we were talking about chip trucks and poutine and things like that. But I was surprised that the post-bar food competitive landscape is so strong in little Kingston, Ontario that they didn't come up with like a different name for the other. Yeah. Like one's the original. Dude,
that's like one of 4 or 5 poutine places in Kingston. Yeah. Like that's all people. Those you go out drinking. It's
that'd be an awful business. You got to stay up late. You're every weekend, and you got to serve poutine to drunk people as they pour out of the bar.
I remember being in I don't even know if it's still there, but Mr. Donaire, and the guy just can see the troublemakers coming in, and right away he's like, "Get the hell out of here!"
Really?
He won't even start to be like, "Just get out."
No way.
And they'll go, he's just like, "Get out of here!" And the guy, I would hate my life. I would hate that. You
need
money.
A bouncer at a
like a Donaire place. Anyway,
yeah. All right.
Going back to what we're talking about. So the poutine of IPOs. Sorry. So we had the scenario where you're building the business long term, building the empire, being sold by a competitor or being bought by a competitor. And then third case is the IPO.
Yeah.
And so what was interesting, so I looked up some data on this because I was like, I haven't heard about, for a while. Remember, I think Alibaba was the last big IPO that I can kind of remember.
Okay.
But apparently there was others, like Snowflake was a big one in the United States, 2021 got a huge valuation. Anyway, so there's basically been this IPO drought. So in the first half of 2025, only 12 VC-backed IPOs happened. So it's one of the lowest counts in decades. So this is in the United States, of course.
Yeah.
Historically, they were the gold standard. So in 2010, 83% of unicorn exits were IPOs, and by 2024, that fell to 11%.
Whoa.
like, whoa, like this is a huge like change. And so it's kind of like a couple of different reasons, like why is this happening? And I guess I'll go to you, but like, why do you think it's happening? I know why, but I'm interested in your hot take.
Ringing the bell at the New York Stock
I
Exchange.
want to ring the bell. I think that's really cool.
As appealing as it used to be.
Maybe they need a bigger bell.
Yeah. That kind of
It's a
sucks
bell
though. And there's
size
no like, if you exit and you sell your company, I think it's just like, you like look at your bank account and you're like, oh, I got a lot of money now, but like, I can't say anything about it. Whereas if you IPO, you can go ring the bell and it's a big moment, I think.
But then why are people not doing it?
I don't know. They are not.
Well, why do you think? That's what I'm saying. Like, what would, my hunch was, and it was accurate, if I do say so myself, was that it's slowed for a bunch of different reasons. Mostly that first is like the crazy regulatory hoops to actually go through with it.
Right.
You have to do a big road show.
You probably have to be like 100 million in revenue.
At least.
Okay. So like,
dude, if you're doing an acquisition in the United States and it's less than 75 million, it doesn't even have to be disclosed to the SEC. Right. So so consider that, like, I think you got to be doing like half a billion. I think, for like practically speaking.
Right. So maybe that's a big part of it too. Is you have to really build your business to get to IPO stage, whereas you can exit much more easily.
Think about some of these AI startups though that we're seeing. So this was the counterpoint. So like some of these huge AI companies are getting tens of billions, hundreds of billions of dollars from private investment.
Yeah.
Right. So there's kind of this thing where you don't really need to go. And the other part of that regulatory piece for the IPO is like, you gotta do a lot of reports.
Yeah.
Your job as a CEO really changes. You probably need a new CEO, to be honest.
Assuming you just hire people in your accounting department to do those reports. Like, it's not like,
I don't think this is trivial. I think it's like, you can, yes, obviously you're
at least $100 million a year company. You can probably afford to hire the accountants to do I don't think the paperwork is really the reason that
but even the ongoing, but then there's like the commitments, like the projections you're going to make to the market. That's going to affect your share price. I think there's like an instability, a more of a perceived instability in the availability of that capital versus going to private equity, who's just going to give you, well, not like with a lot of work as well, but they're going to give you a crap load of money. And you're not tied to what I think the invisible hand of the market. That's what I want to say. Adam Smith isn't out there driving your company. All of a sudden it feels a lot more like, okay, well, we can argue with the board. You can't really argue with the market. So Donald Trump does something crazy and then all of a sudden your stock goes down and you're just like, oh, we just have less money to play with now. Something completely arbitrary. But if you go to private equity, you actually have the means to take that capital, and it doesn't matter in the same way what Donald Trump does. Or it's not as immediate. It buys you time.
I still think you're subject to market forces, regardless if you're private.
I'm not saying you're not subject to market forces, but I am saying that the time when you feel the impact of market forces could potentially be delayed.
Right.
If you're getting private equity.
If you're private equity, you don't have like a valuation that's sitting out there publicly where every time Donald Trump does something weird that your stock price plunges and you got your shareholders then up in your face, because with a private equity, they're not valuing that business like every second. They're just holding it. And I think there is that trend of private for longer, which is fairly consistent. So like, I agree with you. I think there's a lot of companies doing that. And I think there's a lot of private equity money out there. So it's easier to go that route. Like you don't have to be as big. The money's there. Like IPO is just not really seen as the way to do it, or is not as appealing as it was before. Yeah.
I think there's also I think if we were to look back to, so 2010 was the comparison I made, which is all, unfortunately for me, a long time ago now. And the one of the big comparisons there is, if you wanted to get the kind of capital that people are now moving around privately, like $6.6 billion for OpenAI, for example, like that they raised privately, which is like astonishing. But I actually think that's going to be a pretty small number to some of the raises we're going to see for, other companies here like Anthropic and such over the next little bit. Like, I just think that availability of capital now is significantly higher than in 2010.
Right.
You were like, even like relatively, like with inflation and everything, I think it's just, there's a shitload more money available privately than there used to be. And so I think that it becomes a much more compelling argument to someone if you're like, well, how much do you need? We need billions of dollars. Cool. Like we can rein that in without having to go through the filings and the regulatory markets and all these other rules you got to play by going forward. You can continue to sort of operate within reason along the same lines that you've been doing previously.
Yeah.
You know, and also I think, again, company direction and incentives aren't modified. You are on mission for whatever Sam Altman wants to do, as opposed to what the market thinks you ought to be doing. You know what I mean? Like, there's something to be said there.
Okay.
So I think a lot of the time those are aligned. Don't get me wrong, but there's got to be certain situations where, you know, like, well, why did Michael Dell buy back Dell? Right? Because he didn't like the direction it was going. And so he made a public company private again.
Yeah.
Right? Like, there's something to be said there.
Yeah.
So
actually, I had some data on companies that reversed from IPO, like the take private. Where is my data on that? But that is a trend where people business owners are saying, hey, we don't really want to be in the market. We'd rather be private, and we'd rather be doing stuff without these, regulatory hurdles, that kind of stuff. One of the other pieces that I found that is kind of interesting is it's kind of like, when you think about an entrepreneur starting a business, like your exit track, like where do you want to be? What's your horizon look like?
Yeah.
So I looked it up. So if you're VC track, so you're probably 7 to 10 years on average to get to an IPO, assuming you got a solid business and you're growing it and you're doing all the right things.
One of Bryce's power laws.
Yeah, you get to be one of those. You're probably looking at
your unicorn.
Yeah, exactly. The private equity track is more like a 5 to 7 years to acquisition, so happens a little bit faster. But this search fund track is actually the quick one because they're just looking for profitability, right? And they're after that sort of stuff, and that's why that market has exploded.
Search fund is like, so it's interesting because another data point that I have, which I thought was kind of contradictory to search fund, which we'll talk about in a second, was that in July 2025 there were 58 corporate-backed exits worth $37 billion, and it's basically suggesting that was the highest number in 18 months, but still compared to like 2020, 2021, that's like way lower. So corporate acquisitions have also slowed over the past 2 years.
Yeah.
I think this is kind of like fascinating, is because of high interest rates, recession fears, worries about overpaying, like kind of like standard stuff. But generally speaking, there's less of this. But then you have this like kind of other thing happening in the market for entrepreneurs or wannabe entrepreneurs who are getting behind search funds and going and rolling up a series of boomer businesses in the same industry. Tired of business authors and influencers who have never had a successful business? Me too. I sold my company for $40 million, and I want the same success for you. Check out Startup Different on Amazon, Audible, and Kindle. Right. So I did a post on LinkedIn about this, by the way, and this guy, I was like, people are doing this, and this is crazy, and it's like such a lucrative way to go and find profitable businesses or whatever. But watch out what's under the hood, and one of the first comments was a guy goes, "Welcome to 2022," and I'm like, cool, I liked it. I banned him immediately, but
report.
This is
unfollow,
offensive.
block.
He hurt my feelings. No, it's actually hilarious. I marked it as funny, but so like search fund isn't exactly new, but it is an interesting in this scenario. Like, I don't think what's your end game in a search fund? Is it another acquisition from another big company or another group doing search funds and further market consolidation?
I think the real opportunity there is for the entrepreneur that you go out and you find a business that's profitable, you acquire it, and you're probably buying it from a boomer, and hopefully you're not spending a fortune, but you can get a small.
Well, it's a multiple of EBITDA, right?
But then you go out there and you do the thing you're not supposed to do, which is like try and make a monopoly. You go out and you buy the competitors, you try and build it up into a bigger bundle of businesses. You optimize, you implement systems, you do all that.
Sorry, are you saying you don't want to make a monopoly?
No, I do.
Yeah.
You're not supposed to.
No, like that. But anybody who thinks, if you're listening today in business and you're like, businesses aren't supposed to make monopoly, you are wrong. That's exactly what they're supposed to do. Yeah. They're not supposed to do that, but that's what you're trying to do. Well, ideally, you live in a world where you have no competitors that can command the maximum price.
Yeah, exactly.
Right?
You're
and
probably
Peter Thiel is like competing is for losers. You don't want to compete. You want to win and own.
Yeah.
Anyway,
exactly. So I think that's really interesting. I actually have talked to a bunch of different organizations. I was talking to one guy that we know through an investment that we've done, and he actually had pharmacies, bought a bunch of pharmacies, ran the pharmacies, optimized them and stuff that. And then there was somebody else doing a search fund buying pharmacies. So he sold his bundle of pharmacies.
Oh, really? I didn't know that.
But what's really interesting is he kept all the real estate because he owned the buildings.
Oh,
so then he
nice.
became a real estate, like a passive.
Wait, that guy was okay to just buy the business, but not the land.
That's right. They didn't even want the land, which is totally like what we found too with our business, because our office space that we owned was not part of our acquisition. They didn't want the office space. They want the business. They don't want to have to deal with, they find it messy to deal with real estate. Whereas we're kind of like, okay, we'll keep it.
Yeah.
You know, so we'll be landlords, you know? So I thought that was really interesting because there's the business piece of it, but then there's kind of like the assets. And sometimes it's a bit of an asset play. I think I remember hearing a story about, it was like the Pebble Beach Golf Club. Okay. And it was like losing money. It's near San Francisco, as I recall. And it was like losing money. It was like terrible golf course. Like it was a really expensive golf course, but like not doing well financially. Still has a really good name, like all that sort of stuff. Poorly managed, whatever. Okay. The guy buys it and he immediately sells off. There was like a quarry that was part of it.
Yeah.
He immediately sold off the quarry for what he paid for the golf course.
Oh, he must have got sued, right?
So
like from the old owners or something.
No,
I think that's great, but I feel like in America you're gonna.
I feel like this is the kind of move that like a Prof G does, and everybody hails him as a hero.
Oh, totally.
It was totally,
you ran towards the fire, right?
Yeah, totally equity play. Like, oh, I found the value in this.
Did that guy? He must have gone off though while he was doing the due diligence, figured out about this quarry, and then went and was like, "Hey, let's advertise that we're going to have this quarry, find some buyers, and then day one, boom." I guess that's business,
isn't
right?
That like that's business? Like, isn't that the point? Is that people are going out there looking for?
Why the hell do they own a quarry?
I don't know. They own a quarry.
Is it like an aquatic driving range?
It's called Pebble Beach, so maybe that's where the pebbles came from. I don't know.
They import pebbles. We want the golf course to be very authentic.
Yeah, but regardless, so like asset play, and you've got a free golf course. So I just thought that was really interesting, and I think that's what a lot of people are doing with these search funds, or that going and acquiring a business from a boomer is you're looking for like, hey, what's the piece that's actually valuable here, and what do I actually want, and going after that and trying to bundle multiple of them together to make it into a
actually business. There was another point in my notes that was a lot of what's happening now is something called a continuation fund through a venture capital group.
What is that? I've never heard of that.
It's I think it's just a fancy way of saying rather than expecting our payout at 5 years, we expect it at 10 as a venture capitalist group or something like that. So like longer term venture capital thinking.
Yep.
And I think it's probably because in certain markets, they just think that the value of these things is going to increase later. Like it's just so. I think in a way, like why don't so for example, why didn't they want the real estate in our transaction? I think it's because if you were to look at the two assets, let's just make them two assets, the business and the real estate,
right?
You'd be like, the business is the fast growing thing over the short term, worth the short term amount of value probably,
right?
And the real estate is the longer term value.
Think about the timing too. It was 2022.
Yeah.
Downtown Toronto real estate was not super valuable at that point.
I mean,
rents
complicated still now, to be honest with you.
Exactly. Although
it's coming back. Hey, government workers going back to work. TD Bank, you're going back to work.
Yeah.
Anyway, but yeah. So I think, but my point there was that like the nature of some of the private equity is changing, which I think is kind of fascinating. So what does this mean for founders? I think this gets back to like the IPO dream I wouldn't build towards it these days because it seems like a really not good path.
Right.
Like it seems the
path.
Well, and potentially not worth it. Like you might get down that road thinking you want to do the IPO and ring the bell, right? Whereas you might be able to go to private equity, retain a similar amount of control, do another series or late investment that's really significant based on the valuation of your company. You're still a unicorn and everything, but you don't have to deal with all the public filing stuff and all that nature. Like fundamentally, the stock market is about incentivizing people to make teeny little investments in your company so you can use that capital and run with it. But if you've already got like enough money, it's almost like a question of like, what is enough for your company's growth?
Yeah.
And can you find it through less difficult means?
Yeah.
And so I think that might be a super valid path for a lot of entrepreneurs. And the other thing is, if you're going to go down the road of sort of like working with a venture capitalist or investment partners, understand that they're probably not thinking IPO anymore either.
Right.
That they're probably thinking this kind of path as well. Or if they're not, or if you really want that IPO, you better communicate it to them early. Yeah. Because I think they will probably try to talk you out of it, which is kind of an interesting thing.
Yeah.
So
there's definitely like two sides to it. Like there's the companies that I feel like are implementing AI or using AI effectively in their business. And there's a lot of businesses just aren't. And I feel like it's weird because I feel like I would love to go to, let's take something really easy. Let's take a lawn mowing company. Okay. What if you're
what's
the
that
one?
kid's name?
Tyler? Yeah, I never hired him, but
yeah,
I know.
Weird.
Anyways, but you know, so Tyler's got a little business. He's got like 10 clients. He's
Does
probably
he want to IPO?
So I don't think I would ever buy a business like that because you can just go do that yourself, right?
Yeah.
And I think you can actually you don't have to buy them out. You can just wait them out. You can come into the market. You can say, we're going to implement robotic.
Remember you talked
lawnmowers
about
and-
my thing in stealth and you were like an AI first company. Like I think you have the advantage of going into these markets without buying any of the things they do, buying their business and being AI first and crushing them.
Yeah. Yeah. So there's like the search fund, but there's also like, I don't know, I'm just going to copy that business model, do it way better, use AI more effectively.
It's like a seek and destroy.
the search and destroy.
Search and destroy fund. Hell yeah.
Oh, woo. Did we just coin?
We just coined it. Graham, like alert the presses.
Get the domain name.
Get the domain. No, but for real though, like I think that, well, this is the post on LinkedIn where the guy kind of like reminded me that this is happening in 2022.
Okay, so
but hang on. Before that, he like a lot of that post is like, be careful what you buy for. Like, make sure you're looking at the guts of these things. Obviously, you're going to do in due diligence, but if you don't know what you're looking at and you're a starting out entrepreneur, like you might not know what you're looking for.
Yeah.
And there's a lot of skeletons in those closets.
All right, so you need to put together a LinkedIn post that you're really good at those. That's your search and destroy business model.
Hell yeah,
you know,
brother.
Rather than a search fund, you're a search and destroy fund.
That's pretty cool. So the idea is you go into like legacy industries with a bunch of terrible players that do it really inefficiently, and you set up a new business. You're backed by like a venture capital
AI,
and you're AI first, and you go in and you fucking crush them.
Yeah,
I love this idea.
Isn't this actually just being a good entrepreneur?
Yeah, I know. But it sounds way cooler.
It sounds way cooler. Yeah. It's all about the marketing
I'm
stuff.
a fellow at the Search and Destroy Fund. It's like Y Combinator. Like that's old news. I'm part of the Search and Destroy group.
I'm glad
everybody gets a free grenade. Anyway, so.
I'm glad we finally had like a unique thought on this. Now we'll probably go and like Google it and be like, it already exists.
In no way is that depressing. All right, folks. You're here first. Search and Destroy Fund. See you next week.
Start it up, let's get it rolling. Big ideas, money folding, hustle smart, dream so wild. Turn that grind into a joyride.